Cheers. All right, guys. Thanks for being here. Let me go and turn my video on. All right. I'm going to share my screen. Perfect. Type in one if you guys can see and hear me clearly. Cindy says, great pick, Ricky. Thank you. All right. Perfect. Now, first of all, guys, before I start, I just want to see just a show of hands. Type in a 7 if this is your first time at real life trading. I want to see if there's some newbies here, and it's okay if there's not. Oh, there is. Oh, this is great. This is great. This is great. What's going on, AK? We got Jeff, Patsk. All right. So guys, today's the first of all, I really, really do hope that you guys have enjoyed the free week. There's been a ton of amazing traders. You guys have been absolutely amazing, just showing up every single day. So big round of applause to you guys. And I just want to start off by saying you're in the right place. That if you want to learn to trade, there is no place like real life trading. This is where I began as well, and everything's free. Right, and I'm gonna bring you guys a ton of value today, just to kind of ease you off into the weekend. So I hope you guys are gonna love. I hope you guys are gonna love this. So today's class that I'm gonna be doing is gonna be just more of a small taste of what real life trading is offering and what I can help you guys with. And I have titled today's particular session Elevated Option Strategies. Now this one is there is a lot that you guys can do with options, and you're going to see this in just a moment. But just a show of hands, type in a 5 if you have traded options before and you have traded covered calls before. Chris has traded options before and has. Doug, sweet. Evo hasn't. Perfect. Sweet. So a lot of you guys are very familiar of covered calls. So what I'm going to do, and there are some of you who haven't, right? So what I'm going to quickly do is I'm just going to give you a very, very brief introduction to options, what they are, and then we're just going to go on and have a look on the charts, and we're going to go and discuss ways that you can increase cash flow and earn more money. How great does that sound? Type in a 7 if you're ready. Oh, I'm typing 7 in the chart right now, but I'm ready. I'm ready for you guys. Perfect. So first and foremost, what are options? Okay, so options, they're basically a synonym, right? They're a right, right? They're also a choice and a privilege. Okay, stock options are contracts that give a trader or an investor the right, but not the obligation to buy or sell a specified amount of shares of a certain stock at a specified price within a specified time frame, right? They are also known as a derivative, right? Which just means that the value of the contract is derived from the value of the underlying asset. Now, there are two different types. There are two different types of options. One is a call option. All right, you've probably heard of call options and put options before, but just to briefly talk about them, a call option is a contract that gives the owner the right but not the obligation to buy a specific stock, right, or security. And a put option gives the option contract holder the right but not the obligation to sell a specific security, right? So basically, if you wanted to ever buy a stock at a lower price when it has already gone higher, you would have previously bought a call option, right? And the same with a put option. if, has anyone ever watched a stock just absolutely skyrocket and goes, now's the right time to sell. Now's the right time to sell. You own the shares, right? You've owned the shares and you thought, well, I would have loved to sell when it was really, really high, right? Well, you can simply just buy a put option and it will give you that option, right? So why would you want to trade options? Well, first and foremost, options give you options, right? Number two is they also are, if you are buying options, especially, right, it is a smaller capital outlay, right? Because remember, options don't have to just be sold, they can be bought as well, right? They can be bought as well. So they are a smaller capital outlay. People use them to speculate on price, intraday, swing trading, right? Long-term investing, right? They get used for multiple different things. They're cost effective. They can have very large risk to reward properties as well. They are flexible and versatile, and they also have hedging capabilities, as well as can be used as speculation, as I mentioned. Now, today I'm going to cover two strategies. There are multiple strategies, guys, that you guys can do with options. But today I'm relating them back to a covered call, because generally speaking, when you learn about options, when you first learn about options and you want to start to do them safely, I would always suggest that if you're going to get into options first, first start with shares and then go and start with doing covered calls, right? It's probably the safest option, especially if you have a very sound strategy, right? Selling covered calls is a really, really great way to generate another source of income. Also, just getting that consistency, right? Building that consistency, understanding how the options move and how they work. And then later down the track, just go on our website, reallifetrading.com, and I'll show you a couple of different courses you guys can do where you can learn a ton of different strategies. Okay, so today I'm going to talk about a couple of different positions, which is called a covered bear call spread. Right, this is one of Jeremy's secret strategies that he has taught in his hedging with options course. And then, now this looks like a funny name. Don't look this up on Google, right? But a half naked strangle, right? Now this can also be called a half covered strangle, but I like this name better. It's got a bit of a kick to it. I like it. So I'm just going to explain to you guys what a covered bear call spread first is, and then we'll go and do some examples, and then later on we will do the half naked strangle as well. So what is a covered bear call spread? Right, so whilst the regular bear call spread is generally used as a bearish position, when you couple this with owning the underlying shares, you can actually change your original capped upside position to an unlimited upside position while still earning a credit from your covered call. Type in a 6 if you've ever got into a covered call only to watch the stock just continue going in your favor and just going to the moon, and you missing out completely on all that extra upside gain. Type in a 6 if you've ever had that happen to you in a covered call. Yeah, I've been there. There's a lot of you that have been there. If you're just new to options or you're just new to covered calls, it's gonna happen to you. I guarantee it. And says Nvidia, yeah, absolutely, absolutely. So I'm gonna show you how all these work, and I'm gonna show you. We're gonna do a couple of calculations, and we will do this together as a group. But the formulation of, or the construction of, a covered bear call spread position is simply a normal covered call, which is where you buy 100 shares of stock and you sell one out of the money call, right? So that's your simple covered call. But then on top of that, you would buy one out of the money call, right? Now, why would you go and do that? Well, simply, if the stock was to go higher, right, you're selling insurance premiums against your shares anyway, right? You're selling the insurance premiums to get that small downside protection, right, just from earning more income. And then buying the out of the money call is another long position. Now, the reason why you would buy another out of the money call is you would usually look for a call option that is cheaper than the option that you sold, right? And we'll go through a few examples of this, right? And simply, you're getting a free long position, right? Sounds kind of cool, right? So that is a covered bear call spread position. We'll go back to this in just a moment. And then the other strategy that I'm going to be taking you through, guys, is what is a half naked strangle. Okay, so a naked strangle involves selling both a call option and a put option, right? So generally, a naked strangle is used in a neutral is used in a neutral market, usually when a stock is going sideways, right? Usually when it's going sideways and or down, but not too far down, unless you wanted to get put the shares, right? Now, these strike prices for a strangle are typically out of the money. So you wouldn't normally say, for example, if a stock is at $30 and you are looking at selling a put option, you might look at selling the put option at 25, as well as selling a call option at 35, right? Now, the term naked, right, just means that you don't own the underlying asset, right? So a half naked strangle or half covered strangle captures the idea that while one leg of the position is covered by the underlying shares, aka the covered call, the other leg is naked, which means it's just not covered by the underlying asset. Now, you would do this by buying 100 shares of stock, selling one out of the money call, and selling one out of the money put. Now, I personally use these for long-term investing, right? The times that I would use this particular strategy has got to do with long-term investing, or if I'm looking at scaling into a position, right? So some of you may be looking at getting into, let's just say you're looking at getting into Apple. Now, right now, Apple's gapped down, right? It gapped down today. I'm not sure what the price is right now, but we can have a look, right? So if we were to get into Apple, but we didn't want to go all in and buy 500 shares or 300 shares of Apple at the current price, right? But we wanted to, overall, we want to eventually own 500 or 300 shares. We can use this particular strategy to help us get there. And whilst we don't get there, all it's going to do is provide us more income to lower our dollar cost basis on the stock and earn more premium. Now, type in a 5 if all of this makes sense, and if it doesn't, that's okay. I will go through this. We will go through this and we'll write it out. Perfect. There's a few that do understand it. This is great. Perfect. Now, what I'm going to do before I get started, the next slide is actually a checklist for covered calls. Actually, what I'll do is I'll put this up here. So this particular screener that I've used, I use this screener. Oh, this is just a screenshot from FinViz. Now, if you guys want to take a screenshot of this particular filter, go ahead, take a snapshot. I'll leave it up for 5 more seconds. And if you want it again later on, just let me know and I'll give it to you guys. But this is basically what I look for when I'm looking for a covered call, right? The only difference for when I'm selling naked puts is I want it to be, the price doesn't have to be above the 20 SMA. Right? Everything else is pretty much the same. I want to make sure that they're high growing companies, but ultimately this is pretty much what I'm looking at. So that's what we're going to be looking at. Chris says, will this recording be available later? I'm not on my computer. I believe so. I believe the recording will be available. So let's go ahead and let's just go and have a look at a chart. Actually, let me have a look at a few stocks that you guys are potentially looking at doing for covered calls. And I'll just start with one that I'm personally looking at. And I'm just going to start with Target. Right, so TGT. Many reasons why I'm looking at Target for a covered call right now. GP says Amazon. Yeah, we can have a look at Amazon as well. So Target right now, let's just say, and I'm going to bring up here, we'll go to Yahoo Finance, right? I'm going to go to Yahoo Finance and I'll bring up Target. And you guys can go ahead and do this as well. If you're just getting into options and you don't have a broker yet and you wanted to look at option pricing, you can go to Yahoo Finance and go to their tab, type in the stock ticker, and just go to options and you'll have all of this for yourself. So what we'll do is I'm going to go to Target. Now, I'm looking at Target, multiple reasons. We can go and have a look at the fundamentals of their company as well, right? So we'll go here and I'll just go Target. So first thing I can see is they are a profitable company. Looking at their returns, their gross margins, right? Their sales, their income. They are a profitable company. Now, on a technical level, right, we are coming back down to fill a gap, a really, really major gap, in fact. And we're also coming back to test a support level. Right, so 128 currently being support. We do have earnings right around the corner. That doesn't mean that we can't get into a covered call. It doesn't mean that we can't get into any of these strategies. It just means that, you know, beware, right? You can just protect yourself with buying put options to protect your downside. But for example, right, if I was looking at getting into Target, right now, usually the way I get into a position is generally done by selling a naked put. Now, without going into that particular strategy, I'm just going to use buying shares as an example and then selling calls against them. All right, so TGT currently down at 132. I've been watching Target for the last 2 months, waiting for this to pull back down to 128 for a solid buy. And, you know, whilst the market is pulling back, you guys have noticed in the on the SPY, whilst the market is pulling back, Target seems to be holding quite strongly, right? We are getting some rises and some falls, but ultimately we're at a fairly decent level long term. So if I go to Target, and let's just say I'm looking, now usually when you get into a covered call, you want to give it time, right? So the first strategy that I'm actually going to cover is I'm going to cover a covered bear call spread position, right? I'm going to start with this one, which is simply buying 100 shares of stock and selling one out of the money call. All right, so if we go to Target, right, I'm going to go to about 1 month to 6 weeks out. So I'm going to say September 8th, right? If I go September 8th, looking at the calls, so if I was to get into this particular position now, today, right, I would be buying the shares at the market price, which is currently $132.10 roughly. And I'll be looking at selling a call option. Now, you don't have to do these two legs on the same day. Right? You don't have to, but you can, right? You can. Now, the cool thing is when you're playing this particular strategy over an earnings period, if the stock gaps up in your favor, this is where it can really, really, it can work really, really well for you, right? Because remember, you have two long positions. You've got one long position as well as a covered call, right? You've got so for example, if I go to Target, if I wanted to sell my stock at a 130, so we're at currently 130, 132. If I wanted to sell my stock at 138, which is a previous resistance level, right? That's $6 higher than our current position, right? Now with 100 shares, that's $600, right? $6 times 100 shares, it's $100. Oh, sorry, $600. And that's if we get there. That's if we get there. So you'll see if I get so if I go to Target, if I was to buy the shares and sell a $138 option until September, right? We're going to receive $3.90 in premium, or $390 in cash, right? $390 is going to come to us. That's what we're going to get paid from our insurance premium to the upside. And so basically about $400, close to $400 for this particular trade. Now, if the stock goes completely sideways, right? If the stock goes completely sideways and we just done a covered call, and it doesn't reach 138, the option simply expires and we get to keep that $390 and then rinse and repeat, do it again the next month, right? Now, the moment that the bear call spread position comes in is when you buy an out of the money call at a higher strike price. Now, when you do a bear call spread on their own, I didn't mention this before, but I'll mention it now. Usually this is a bearish position, right? And if the stock does rise above both the call option and the sold call option and the bought to open call option as well, right? There is actually a capital loss, right? There's a capital loss between the two strike prices of these two options. So for example, if I was to sell a $138 call option for $3.90 and buy a call option for the same expiration, right? And I was to buy a call option for 145, if the stock went to 150, right, I would actually lose out on $7 or $700 on that particular trade. Now, when you own the underlying asset, the cool thing is if we were to own the underlying shares at 132 right now, and the stock went to 138 or higher, right, we would simply get our $600 profit from the stocks and selling the option, as well as the premium that we've received. So when I look at a covered call, right, when I look at a covered call, I generally look at my dollar cost average of that stock. So the current price is 132. If I sold, I'm just going to round this to $4 just to make things a little bit easier, right? To round this to $4, $138 as a target price. if I bought the shares for 132 and I received $4 in premium, technically my dollar cost average is $128 and my profit would be $10, right? Between $128 and $138 or $1,000 per contract. All right, who's following so far? Type in a 7. Perfect. Perfect. Now there are different courses that I'll point you in the directions to learn about these particular strategies, guys. If you do fall behind, or there will be the recording as well. But so simply now, if we were to own the shares, and our dollar cost average is 128 to 138, $10, make $1,000. That's great for a covered call. That's perfect, right? I think that's a great return. You could have 1 contract, 10 contracts, right? Now, if we bought a call, right? If we bought a call option for 145, and then we just posted an amazing we posted an amazing gain on the stock, right? And let's just say the stock went from 132 and gapped up huge to 150. Well, we're in luck, right? We're in massive luck. Now, it doesn't have to gap that far, but if it did, right, you won't be upset because yes, your covered call is capped at 138, right? You will definitely make your $600 on that particular trade, as well as your $1,000, I should say, including the premiums. But the call option that you've bought is also going to increase in price as well. Right? Remember, when you buy a call option, it increases in value as the stock goes higher. Now, if you were to buy the $145 call option for the same period, it's going to cost you $1.90. Right? So $1.90, or we'll just call it, say, $2, right? If you're doing this particular constructive strategy, you're basically getting 1 free long position for 6 weeks. Right, and I say free because the premium that you're receiving is $4, right? You're receiving $4 for the call option that you're selling, and then you're only spending $2 on the other option, right? So you've still got a $2 credit from this stock, bringing your break even or your dollar cost average down to $130. So $130, your dollar cost average is basically at this strong level of support. Now, you're probably thinking, Ricky, what if the stock gaps down over earnings? It could, absolutely. And in which case you could just protect yourself, right? You could buy a put option, right? Another thing is you could also look to use this second strategy as well, if you were looking to pyramid into this position, right? So remember before I said you don't have to get into a position when you're getting into a long-term position. If you're building your portfolio, you don't have to get into the shares on day one. You don't have to get into 500 shares on day one. You can get into 100 shares as well as getting into another 100 shares later down the track. Right? Cindy says, looks like a bear flag. What about the downside? Yeah, yeah, absolutely. I get that. I understand that. So you can't, like I said, you can protect your downside by buying a put option, or if you're scaling into a position and this isn't your full size, this is just a starter position, right? You can get into what I like to call a half naked strangle, which instead of buying a put option, right, or selling a call or buying a call option for the upside, you're selling an out of the money put option to acquire more shares at a lower strike. So simply, you're just going to get paid more money for a position that you're already in. And it also gives you the opportunity to pyramid into that stock, that particular stock. There's many stocks out there that we can go and have a look at. But I'll give you guys an example of this one for Target, right? So if I go to, I'm just going to bring up a calculator here just to make things a little bit more simple, right? So before we were looking at a covered call on Target, and we're looking at receiving, say, $4. So I'm just going to round this up to $4. So $4 divided by the current price, which is $132, right? $4 divided by 132, multiplied by 100 is 3%, right? This is for 6 weeks, guys. Now, I know there's a lot of you that are in real estate, right? Probably getting about maybe 4 to 6% per annum in returns, right? Now, that's per year, usually. Doing a covered call, this is what initially got me excited about the stock market. Covered calls was the first thing I ever learned about the stock market. And it was the returns that you're getting. Now, 3% doesn't sound like a lot of money, but it depends on how much money you're investing. Right? If you're investing $100,000, that's $3,000 for doing absolutely nothing. Right? Just getting into a position where you're receiving $3,000 on a $100,000 investment. Right? There's not many houses that you can go and buy that are $100,000 out there that are going to pay you for 6 weeks $3,000 in rent. And that's just another way of explaining what a covered call is. It's basically like renting out your shares. Now keep in mind, team, the 3% that you're getting on this particular position is not including the capital gain that you will possibly get on the upside. Right? Remember, there is a potential for this to still make a further $6 in capital growth. Now, if we were to get, right, I mean, type in a 5 if you guys would love to get 3% return, right? And let's do this actually before I do this. Serge is like 5. I'm there. I'm getting excited already. I love it. I love your energy, man. So now if we go to all the way to $138 with a covered call, and we get that extra $6, right? Our returns would actually be $10, right? We've got the $4 from our previous, sold option, right? But the 10 is going to be, right? Divide that by 132, which is our original risk, right? The $10, our return is going to be upwards of 7% return. Now we can make that better, right? 7% is great, right? That's turning your $100,000 investment or your $10,000 investment. We can use smaller numbers for this as well, right? But it is a 7.5% return if we get called away. Now we can make that better by, if we sold that put option, right? If we sold that put option a little bit further away and got into the half naked strangle position, right? And we're looking at scaling into this position, right? Because you may be someone that's like, hey, you know what? I love Target. I love where it's at. I want to get in, but I don't want to go in heavy right now. I want to slowly scale up my position. Well, you can do that simply by selling a put at a lower strike price. So we're going to go 138, get the original $3.90 or the original $4, right? And then we're going to look at where would I like to buy more shares of Target, right? I'll probably look at about 120, right? 120 is just below this next pivot, right? It's also, if we go to a weekly chart and we'll go to the longer term moving averages, the monthly chart, sorry. The monthly chart, longer term moving averages, actually $110 is the 100 simple moving average. So we could probably go to 110 if there's any premiums there. We'll have a look. But $110 is the 100 simple moving average on a monthly chart. Right. So if we were to go to $110 and we sold a put option, there's not going to be as much premium there, as you guys can see. But there is an extra dollar, roughly, an extra dollar at 115. My original thoughts were to go to 120, which is an extra $2.10. Right. So our $2.10, right, that's going to bring our original return up. Right. So once again, I'll go back to the calculator. We were originally getting $4. Now, this was including our capital growth that we get if we just did a covered call and the stock went higher. Right. Now, without that, we were going to get 3% regardless. Right. We're going to get 3% return regardless. Now, if we get another $2 on top of that, right, that brings our total return. That brings our total return to around $6 in premiums. Right. And we divide that by our original investment of 132. Right. Now we're getting all of a sudden 4.5% return for 6 weeks. Type in a 5 if you guys would love to get 4.5% return in 6 weeks just for like selling calls, basically. Bill's like 5. Yep, I want to be there. So guys, this is just another way of, you know, expanding the position that you're currently in, right? At the same time, getting higher returns on the position that you're already on. Now, the cool thing is you're not going to have to fork out the extra money for this stock unless the stock goes below or closes below. I say not goes below, but closes below $120, right? Which is all the way down here. $120, 120. At the end of the expiration, right? We have already fallen, I believe it's about 50% from the highs. Where are we? They've moved them on me. Price range, here we go. So we have already moved down already 50% on a profitable company, right? The stock would have to drop from 132. It would have to drop basically another 10% from where we are today. And if we dropped another 10% lower, you're buying the stock another 10% lower as well. So, you know, this is another way of dollar cost averaging into your stock. All right. Now, the upside, of course, is if we get into this previous position, selling a bear call spread with a covered call, or at least owning the other shares, the underlying shares of this asset. If over earnings, we get a large gap up, you're going to be very happy on target. Simple. Cameron says, so sell my rental properties, buy 100 shares at the time to get 4% every 6 weeks, quit my job, easy peasy. I mean, you could if you're doing it right. You could. I mean, I did that. almost in that order. Almost in that order. Now, you're not going to get you're not going to get 4% every 6 weeks, right? The reason why this particular stock is going to show higher returns is simply by selling an option over earnings. But it does give you an idea of how you can, how you can pyramid into a position. And it also gives you an idea of how you can capitalize on the upside and not have to pay for that particular option. right? Now, what I will do, guys, is on your dashboard, there is another strategy that has been thrown around in real life trading. I'm not sure if you guys have heard it this week, but it definitely gets spoken about in Slack a lot, and that is the Cadan cannon, right? It's an option strategy that is extremely bullish. And the last time that we, well, not the last time that we did this at real life trading, but I do recall back in, I think it was 2021, that I gave this to everyone at real life trading. Now look at this, guys. Look at this fantastic trade. Now this was an official trade at real life trading. Actually, I love this trade setup so much that I had to publish it. Now, looking at this particular position, now could you have gotten into this position? Type in a 6 if you could have used this position, right, to get into a covered call. This same setup, right? It doesn't have to be buying call options. You could have got into this position with getting into a covered call and selling buying a out of the money call with the premiums that you've received on the covered call, right, and getting into a covered bear call spread position. Right, type in a 7 if you guys could have done that on Wix on this particular strategy, like on this particular setup, right? We could have bought the stock at $77 only to watch this go higher. Now, if we sold an option at, say, at our target, this is when the trade works really, really well in your favor, right? This was only about 6 weeks ago, right? It was only about 6 weeks ago, and you'll see that if we had our covered call and we said, you know what, I'm going to buy the shares at 77 and I'm going to sell all my shares at 85. That is a fantastic trade. You've made $8 to the upside as well as premium that you've received. This was all before earnings, right? But then if you had bought the call option at 90, which was a previous resistance level, now those call options would have been up in the money at open massively, right? They would have been up massively, especially just before this big bearish day. But alas, you still would have been up, right? And you still would have capitalized on this whole move, right? So this is when this particular trade works in your favor. Jack says, so you're basically giving up the 85. So you're basically giving up the 85 to 90 move. Yes, correct. Correct. No, you basically are. Yeah. Yeah, because obviously, as time progresses or as time goes on, right, you do have time decay on these options. Cindy says, is the bought call at the same expiration? Great question. It can be. It doesn't have to be. It can be, but it doesn't have to be. You can turn this into a diagonal trade. Right. So for example, you might look at this option and say, you know what, September, let's go to Wix actually. We'll go to Wix as an example. And we'll go to options. And what I'll do is I'm just going to go from, these are currently just all monthly. So I'm going to go September 15th. Right, so September 15th, current price of the stock is 94. Right, so we could look at selling a covered call at, say, $100, right? It's about $5 or $6 higher, and get paid $4.39, or actually around $4, between $3.70 and $3.90. So you could get into this particular position. Now, this is not, I'm not telling you to guys get into this. This is completely just an example, right? But if you were to buy a call option, right, for say roughly $1.70 or $1.90, right, $1.95, if you were to buy a call option at 110, right, you're just going to give up $2 worth of premium. And as this stock goes higher, obviously the stock would have to go to over $110 for this to be extremely profitable right now. But you guys get the point, right? You've got that unlimited upside potential just in case we do start to break out. Now, the reason I'm telling you guys about these strategies is because we're no longer in a bear market, right? We are shifting back towards a bull market. Right now, we may consolidate for a little while. That's fine, right? But there are a lot of positions that look a lot like this, right? There's a lot of companies out there that are accumulating long-term at very low levels, which are starting to pop, right? This particular stock just in the last 6 weeks went up 30%, right? Just went up 30%. So obviously you expect a bit of a pullback, but if you had another position on here back down at these lows, you would have been able to take advantage of this. Now, there is another strategy, as I mentioned, the Cadan, which I won't go into because I've already done a complete presentation on this, and you guys can find this on the Real Life Trading dashboard. So this, if it's not already on your dashboard, it'll be in one of the premium courses. Now, guys, this is probably the best value that you're going to get in terms of, other than being free, right? Other than being free, that you would have to pay for, right? The Trader Summit here recordings is $10. Right, you guys can purchase it on your dashboard. $10. It's like just, you know, it's like an extra large frappe, or it's like having 2 coffees, right? But I teach a particular strategy in here called a diagonal synthetic long stock split strike, aka the Cadan, and I do remember giving this out to everyone at Real Life Trading as a small Christmas gift back in, sorry, it was 2020. We closed the position out right at the highs here, 350. But I'll show you guys what this particular position looked like. Right, and this is just to give you guys an example of what else you guys can do with options. This was another position. I'll just kind of zoom out here if it'll let me. Or maybe not. Maybe it won't let me. But that's okay. So all this one is, right? Can I bring this up? No, it's fine. I'll leave this. But basically what it is you sell a put option, right, for a longer period of time. So I know that Cindy asked, buying, is buying the call option at the same expiration. On this particular strategy, you don't. Jack says, and also sell a put or buy a put. Was that in relation to, let me just go back a bit. So Jack, was this in position? Was this in relation to this particular trade? The put was in relation to the Wix trade. Yes. Yeah. So with Wix. So if you were looking at Wix, for example, I'll just go to the daily here. So if you were looking at Wix, in relation to Wix, if you were looking at, once again, if you were looking at pyramiding into this particular position, you could have bought the stock, right? You could have bought the stock down here, sold a covered call at, say, 85, right? Which is just a previous resistance level. And then you could have sold a put option at, say, 65, right? To earn yourself more premiums, but also give you an option to, accumulate more shares at a lower strike. Because if you bought the stock at, say, 75 and then you sold it at, and then you sold another put option at 65, your dollar cost average on the 200 shares that you would have purchased if the stock went down would be $70. Would be $70. So it'll be in the middle, right? Which is still below this major level of support. So yeah, absolutely. Now, I think your other question was, can could you sell the put as well as buy the call? Man, you can do whatever you want. That's the thing with options. There are so many options when it comes to options. You can do that. So you can get more premium, right? As well as have infinite upside. So yeah, great question. Really, really, really great question. I don't personally have a name for that trade, but now I like the way you're thinking, right? You're starting to think outside the box, right? When you start to understand how options move and what you can actually use with them and how you can use them as a tool, the opportunities literally become endless, guys. They literally become endless. So with that, I just wanted to kind of open up questions to you guys, maybe give another example, right? Maybe give another, I'm happy to go through and give another example, but type in a 6 if you found a lot of value from this or you really enjoyed these two particular strategies that you guys can now go and use. Perfect. I love that. Absolutely love that. Thanks, guys. So right now, I mean, we can go and have a look at some really, really great strategies. We can go through this. Now, if you wanted this filter, you can go and take a screenshot. Jack says, can I ask your opinion on a trade strategy? Absolutely. Ask away. I'm all ears. And definitely ask as many questions as you like, guys. Carl says, did you say we can purchase this week's free week for $10? Nope. I said that you can purchase the Trader Summit for $10. You can purchase the Trader Summit recordings for $10. Now, what I'll do is I'll click on this, right? Just so you guys see what it is. What comes with this, right? This was a Trader Summit that we did at Real Life Trading in 2020. But each one of these videos is roughly, 45 minutes to an hour long, right? If you are looking for a mentor at Real Life Trading and you want to learn specific things, right? This is just a small taste of what you guys can learn through each and every one of us, right? So you got Tony Pollock, Dan Jansen, David Potvin, Tracy Ball, right? Obviously you got Jeremy Newsom, Matt DeLong, Johnny Guarco, myself as well. And you've also got Robert Thompson. Like there are so many, so many amazing traders at Real Life Trading. You guys can learn and do mentorships. You guys can do one-on-one coaching, right? But this will give you a starting point to, what you want to learn, and give you their style of trading, etc. So $10, get like almost 10 hours worth of trading. It is incredible. Jack says, I was thinking to hedge a portfolio, buying SPY put. Let's go here, right? Buying a SPY put at 430 and selling 2 SPY puts at 385. The net cost of this trade would be 0. I love it. You could do that. Absolutely. Yep. You most definitely can. Yep, this is another strategy. So there are multiple strategies. If you guys want to go deep into options, right? If you guys want to go deep into options, the hedging with options strategy at Real Life Trading is phenomenal, right? This will teach you a ton of different ways to hedge portfolios with options. So this might be one for you, Jack, if you haven't done it already, right? Hedging with options. Go and check out that particular course. It's amazing. But then, other than that, if you want to learn about options, you can just type in Real Life Trading stock options in YouTube, and there is a ton of videos in there. Cindy says, I've taken both versions. Both are excellent. They are incredible. Actually, hedging with options, when I first seen this, it kind of blew my mind, and I'm like, hang on a minute, I could create my own strategy here. And that's how the half naked strangle came about, as well as the Cadan cannon. These are multiple strategies that have just came out of the blue that I've just come up with myself and named them whatever I want to call them. So Scott says, thanks, Ricky and RLT. Got to go. Have a great weekend. You're a legend, Scott. Thanks for being here, champion. I am going to be finishing up in just a moment. But if you guys have any questions for me, what I'll do is I will post in the chat pane my email. So Ricky at reallifetrading.com. Feel free to ask me any questions. If you guys want one-on-one coaching, reach out to me. I'm happy to help coach you. If you guys just want to send me an email to say hi and thanks for the free week, or thanks for the value that we brought, I absolutely love those emails as well. So I just wanted to thank each and every one of you for your time in the free week, and also wanted to thank you guys all for the time that you've had with me this afternoon or this morning for myself. Rob says, all the best, go well. Alex says, thanks, Ricky, you're welcome. Cindy says, my overall market outlook. So my overall market outlook, we can go through that quickly. Alex says, are you going to be on at this time regularly? If you want to find out when I'm actually trading live with you guys, if you just go to Real Life Trading /all access, the live trading tab at reallifetrading.com. You can simply just go to the calendar, and each day, so I'm on so Tuesday, this is in my time. So the Wednesday is actually your Tuesday